What are your clients saying, Stephen, when we see this sort of volatility and the dour August that we've seen cross-asset, really?
I think like a lot of individuals, they're wishing it was all over with. They were wishing that this was the moment where we could have a decisive move higher or in some cases lower, where we could think about a new investment cycle where there's nothing but growth ahead. And unfortunately, this is this period where we have an awful lot of monetary tightening still in the works in the economy. Even if the Federal Reserve were to stop raising rates at this point, we would still have the impact felt in the coming year. And we have to really gauge the depth of that impact before we can really think about that new economic cycle.
Is the depth of that impact a retesting of those June lows?
I just think the arguments for a rebound were poor. It's not that we necessarily need to get to lower lows. I think we had a good economic downturn priced in. I think we're pricing in 1 to 2 million job losses next year. But the idea that we could already move forward and price in the recovery, that was the strain part. If you think about the average period when we had 2 consecutive quarters of down GDP, the 12-month ahead outlook has averaged a 24% gain for the S&P 500. The problem is, when we've had those declines in GDP, we've also had profit declines behind us. And we think, again, 2024 is the year which we'll have higher profits. Doesn't mean there's nothing to invest in right now, but not to get really long cyclical assets.